Hi, and welcome to the basic concept of spread trading. This webinar will present the basic concept of spread trading futures contracts. We will cover what is spread trading, reading a spread chart, types of future spreads, and the key features and benefits of spread trading. Spread trading is when you buy a futures contract and sell a related futures contract at the same time. When you do this, you are trading the difference or spread price between the two contracts. By combining a long and short position, you create an entirely new trading entity, which is essentially a new futures contract. The new spread has the same characteristics as an outright contract with an open, high, low, and settlement price. Let's have a look at how a spread chart is created. As you can see in this slide, it is difficult to distinguish any difference between the two contracts in a chart. They appear to be identical, but when you subtract the price of December corn from July corn, you find the price differential, or spread price, of -21. When you combine the two contracts, you create a new futures contract and chart called the December-July corn spread. In this slide, you see the December-July corn spread in a bar chart form, showing its daily open, high, low, and settlement. The second type of chart is called a line chart, which is simply the daily settlement prices connected by a line. Essentially, there are three types of future spreads. In all cases, spread trading attempts to capture the price differential between two contracts. The idea is that one contract will outpace the other in price, regardless of the price movement to the underlying contracts they are based upon. The first type is intra-market or calendar spreads. These are identical contracts with different expiration times. The second type is intermarket spreads, which are different but closely related contracts listed on the same exchange and have identical expiration times. And the third type is inter-exchange spreads, which are related contracts but are listed at different exchanges. Here is a short list of the features and benefits of spread trading. You have reduced volatility because you are holding a long and a short position and have less risk than an outright position. You have reduced margins. An example is the margin for heating oil, which is $5,063, while a calendar spread in heating oil requires only $550, or 90% less in margin. As a trend trader in spreads, you inherently become a position trader. You have true market activity because a majority of spreads are not held to the influence of running stops or large commercial involvement as with an outright position. Also, spreads trend more often than outrights. In fact, spreads can trend even while the underlying futures are moving sideways. And finally, seasonal patterns are the tendency for a particular spread to behave price-wise during a certain calendar period every year. The statistical time frame to enter and exit a particular trade provides a real window of opportunity. As a result, you can plan spread trades several days in advance and do not need a technical indicator to trigger you into the trade. If you would like to see an advanced webinar where we present a specific entry and exit technique, please visit the YouTube video called Spread Trading Advanced or visit the Just Spreads website for a free 2-week trial.